Hey everyone, welcome in to another daily editorial. Here on the KE Report, we're chatting with Jordan Roy-Byrne and we're recapping a recent presentation he did at the Metals Investor Forum where the title is "The Biggest Breakout in 50 Years is Here," focused on precious metals. Now, Jordan, we've chatted with you a number of times regarding the positive moves in gold and even silver following along, even how the underlying equities have done compared, at least recently, to the metals prices. Elaborate, though, in terms of that headline here, the biggest breakout in 50 years. Look, this is critical, so please elaborate.
Yeah, Corey. Well, it's something I've been talking about for the last couple years, even prematurely. I thought we had it, potentially in 2022, and even about a year ago or so, it looked like we were so close to breaking out and pulling away. But nevertheless, it's clearly here now. As in March, we broke out from this 13-year cup and handle pattern in gold. And if you look at these types of multi-decade breakouts in markets, especially major markets, they're really, really rare. The stock market has basically had three of those types of breakouts in the last 90 to 100 years. And if you look at gold, the 1971 breakout was kind of artificial because the price was artificially low because of the gold standard. After that, you had various breakouts in the bull market, the secular bull market from 2000 to 2011. The biggest of those, I would say, was the 2005 breakout, where you were breaking out from not a perfect 22 or 23-year base, but you could draw a trend line that's slightly sloping lower, where gold had declining highs in the 400s. It hadn't been above 500 basically for 20 plus years. So that breakout, to me, was the biggest one of the last bull market, because it was over a 2-decade base. However, it was not at an all-time high. Typically a lot of these breakouts, they come at or around all-time highs. So for me, this breakout in gold is superior to the one in 2005. And while we have not confirmed it yet, this is the start of a new secular bull market in precious metals. And this breakout has hugely bullish implications, not just for the next year, 3 or 4 years, but over the next decade. I mean, we are in a new secular bull market for gold. And, once we get the 60-40, making a big move higher, which probably means more stock market weakness. I mean, that's the real missing link. Once we get that weakness in the stock market, that's what's needed. And that is going to propel gold to, eventually, I think, $3,000, $4,000, $5,000 an ounce in the next few years. So time will tell if the statement about being the biggest breakout in 50 years is really correct. But just based on the evidence and everything that I'm looking at, this is the biggest breakout in precious metals in the last 50 years. And it's pretty exciting because the breakouts after this to come, we talked about the inflation adjusted price of gold, that has a 45-year base. It's coming up on, so that could break out in the next 12 months or within the next 12 months. And then after that, silver breaking above 50, maybe that'll be a little while longer after the inflation adjusted gold price breaks out. But, silver would be the third breakout in that series. So we are at the start of what should be a really, really exciting and profitable time for precious metals investors. And, it's going to take, we've been in a secular bear market and we're only a couple months into a new secular bull. So it's going to take a lot of time for the sentiment to really catch up with that.
Well, Jordan, one thing that I really took away from your presentation at the MIF, just in reviewing it, was a lot of these discussions we've had individually over the weeks and months and years, but you synced them all up where you talked about the 13-year cup and handle breakout and then even the little mini cup and handle breakout and where that extrapolates out to. And then you showed, like you mentioned, the inflation adjusted price of gold, that 45-year basing and how that's getting close to breaking out as another confirmation. But then you got into the point you made earlier about the 60-40 portfolio, the traditional equities and bonds investments that most investors hold versus gold. And I'd love you to maybe just expand on that a little bit further, because that's what you're really looking for as the real signal to show you that it's not just a cyclical bull, that it's a secular bull.
Yes, and that's a great point, or a great question, I should say, because when you're in a gold secular bull market, gold is outperforming everything. I mean, it's also the case when you're in a secular bull market for stocks. The stock market should be outperforming everything. It should be outperforming bonds, gold, commodities, etc. So we have seen gold break out. It has moved up. Now, the bond market has fallen and cracked. We are in a new secular bear for bonds. Same thing happened in 1965 or so, right after you had the gold stocks break out from a 28-year base. But then, it took a little bit longer for the secular bull in the stock market in the mid to late 60s to end and flip into a secular bear. And so if we think about gold and what's been moving it higher, we know the central bank buying not from ETFs, but yes, buying from central banks, buying from governments, buying from places outside the U.S. because those currencies have been very weak in recent years. And that allowed gold to correct or consolidate bullishly and build the handle and, not fall to 1,500, 1,300, et cetera. And yes, gold has broken out now. But for gold to make those huge moves higher, more money is going to have to come in to the sector. And in 1972, 2002, when we got confirmation from gold breaking out against the 60-40 or really accelerating, money was moving out of stock markets at those times and going into gold. And so when you have the stock market cracking and you have a recession, all that capital is going to move from U.S. equities into gold. And so there's a cap on gold right now because as the stock market, let's just say, continues to rise for a little while, all these people, normie investors and, normie fund managers, they don't have to buy gold. They might be buying a few gold stocks here and there, but they don't have to make it a big position because the stock market is working. And, money has come out of bonds. I think that's helped gold quite a bit in recent years. But you need money to come out of the stock market. That's what really will propel gold to 3, 4, 5,000. And you're in a new real secular bull market then, where it's obvious and everybody knows gold's in a new secular bull. Stock market secular bull is over. You need to go more into gold now. Granted, that'll happen at higher prices. But, here and now, all those investors and those normie investors, they don't need to go into gold yet because the stock market is still working. Global equities are still working. So that's the last thing here to really take precious metals much, much higher and confirm that we're in a new secular bull market. It's really difficult to say, well, we're not in a new secular bull after we had this 13-year cup and handle breakout, but that's the last thing for gold. And so gold is not getting to $3,000, $4,000, $5,000 with the stock market at all-time highs. I mean, that's not how markets work.
Yeah, that's a good point, Jordan. You're right. For all these other investors, there are other sectors working that keeps their capital in there. What do you use to judge Western demand? We hear a lot about ETF inflows and outflows, but there any other data that you look at that gives you a barometer of at least when Western demand could shift more favorably towards the precious metals?
Yeah, I think it's, gold against the 60-40, gold against the stock market, looking at those ratios. And, when we see more strength in those areas, I think that's when we'll see more ETF demand. We probably, again, we need to see the stock market crack, the economy really run into serious problems for Westerners to buy the gold ETFs and see the fund flows in the ETFs. But yeah, they haven't been buying yet because they've been able to continue to buy stocks. But yeah, to directly answer your question, no, there's nothing else I really look at aside from the ETF flows.
Well, Jordan, let's also do a worst case scenario here. You outlined in your presentation about 7 or 8 other cyclical bulls. So let's just say that we don't get the confirmation from the 60-40 and gold versus equities that it's actually breaking out in a secular way. Even on secular terms, you noted that most of them are average around 3 years in length. I'd love you to just outline where you think this particular cyclical cycle started, and in a worst case scenario, what would a cyclical bull look like?
Yeah, I mean, it's a good question, but if this is a cyclical, or if we are not in a secular bull, then the time of this move would peter out. So I mean, depending on, I mean, if you mark this at the end of 23, then, I'm looking at the gold chart, maybe we would have like another good 12 months left where, maybe gold goes to 2,700 and then, you do this retest where it comes back to 2,100 and, then it corrects and consolidates for a little while. And then at that point, in a 2-3 years, maybe that's the official beginning of the secular bull. So to me, that would be the worst case scenario. I mean, based on history, in the majority of the cyclical bulls that I'm looking at, they were in secular bulls. So if we're thinking about a cyclical bull, but not a secular bull, then it's not going to be around the 3-year average that I'm talking about. It would be 2 years or less. But what I talked about in the presentation is, I mean, it's in the context of a secular bull. And so even in a secular bull, based on how I measure these cyclical moves in gold, they tend to be around 3 years. I mean, there's a few that are a little shorter. There's some that are, 3.5, 3.75. So generally looking at the cyclical bulls for gold, they're really not that long based on how I measure them. And so how I am measuring this one, I'll give you an example. The start of this one was October 2023 for me. It wasn't the low in 2022. So based on that, October 2023 is the start. And if these average around 3 years, then, I'm thinking for this cyclical bull, late 26, maybe early 2027 or mid 2027, perhaps. That to me is perhaps when this particular cyclical bull could end. And, I threw up an analog chart there in the presentation looking at the 2005 to 2008 move, the 2008 to 2011 move, and then you have the two in the 70s, which are off the chart basically. Based on the cup and handle breakout, being, as I said, the biggest breakout in 50 years, this cyclical move, it should be bigger than the 08 to 11, 05 to 08 moves. And so, based on that, I think that puts this at a minimum, probably around $5,000 an ounce or very, very close. So based on that, I mean, I would get a 5,000 target, again, late 26 or early 27. And, I would also mention the measured upside target for the cup and handles around 3,000, the log target where you're looking at percent moves, that comes in around 4,000. Historically, from the other patterns I've looked at, they went from the measured upside to the log in about 6 to 12 months. So if we're going to hit 3,000, we could say, end of this year or early next year, throw another 6 to 12 months on top of that, you get to 4,000. Then you have, maybe another 9, 12 months for the cyclical bull market. And, at the end, if you get a bit of a vertical move, that rhino horn, that's how you can get to 5,000, maybe 6,000 for the end of the cyclical move. And, the one thing is all this technical stuff is great, but this is in the context of you have a breakdown in the stock market and you have a real recession. So if you're telling me we're not going to have a recession, the stock market's going to keep rising, for the next 2.5 years, then it's really hard for me to see gold going that high. So this is all in the context of that macro development. Because otherwise, if you're just looking at technicals only and you can't align it with some fundamental development that will actually cause these moves to happen, that it's, you're just pissing in the wind, so to speak.
Yeah, fair enough. That's a good nuance to take note of there, Jordan, is that you do still need that market breakdown and correction to happen while precious metals keep moving higher. What does this mean for the underlying equities then? Should investors be going down into the equities, or should they just be playing a leveraged gold ETF maybe to take advantage of these gold gains?
Well, I mean, I think this is the time for the equities. This is a real sweet spot. And you have to distinguish, people are saying, they ask me, well, should you go into explorers now, or, do people buy producers and then they buy the, developers, and, do they buy the explorers after that? For me, I always say this, like, just try and buy value, try and look for things on a company by company basis. Like, just start with the individual companies. Like, don't try and get too cute and think, okay, well, this is happening and I need to buy a silver stock now, so I'm going to buy X silver stock. Like, that's all fine and good, but just first and foremost, focus on the companies. As to when the explorers might lead, I still think it'll take some time because you're looking at junior producers now. If they're producing, they're making money, the trend is higher for the sector. We're in a new bull market. They have immediate upside, because of the leverage and a higher gold price and a higher real price of gold. It's the same for good developers that have economic projects. But if you're looking at small explorers that, maybe they only have 1 million ounces or, they're just starting out and they have some money and they have targets, that's not going to be really leveraged to the bull market. Like, you have to have something to leverage. You need that 2 to 3 million ounce quality deposit. You need production and growing production. So people should just understand these things when they think, okay, now I got to go into all these small explorers because they're going to really, really outperform now. You just have to be careful about that, because if you get too cute and you don't do enough analysis on the individual companies, then you could waste some time during the bull market where your stocks are not moving. But that's the reality here and now. You got to have economic gold, and you got to have growing production and cash flow. Those are the things that are going to be leveraged here and now. Now, at some point, maybe later this move, in the middle of the next leg higher, maybe that'll start to filter down to these explorers that really don't have anything yet.
Yeah, great points, Jordan. You got to have the ounces in the ground to get the leverage. And so whether that's in a development stage project that's moving towards production, or producers that can monetize the higher gold prices with better margins, that's where their leverage comes in. But you also mentioned to us off mic that there's a group of stocks that you would avoid dealing with the orphan stocks. So maybe speak to that point.
Okay, yeah. Well, this is a concept I've been thinking about for the last few weeks. And when you're looking at developers, like, I tend to like the developers where they're going to be able to finance the project and then build it and go into production. Like, it's looking at, okay, we have this cyclical bull. It's probably going to last another 3.5 years, maybe 2.5. Like, maybe it'll happen faster than I think. So looking at developers, you got to have something that could finance and build the project in the next 3 years. Because if not, it's too far in the future and you're not going to get that re-rating. Like, that re-rating, it's not going to happen. It's not going to be magnified during the cyclical bull. So you have to look for ones that can be financed and can actually build the mine. And so the other thing is, or it's something that has to be a takeover target. Now, it requires more work and experience in the sector, because some people might assume like everything's going to be a takeover. Well, this has 10 million ounces or 5 million. This is going to be a takeover target. But the reality is, if they're not going to build the mine, it has to be something where the deposit is good enough where it will be acquired and taken over. Because if a developer does not fall into one of these two categories, it's an orphan. What I mean by that is the project is not good enough for the industry to care about it or for somebody to take it over. So therefore, the company is going to have to build the project. But if it's really not that good, and if it's too expensive to build and it's kind of marginal, then it's an orphan, because they're not going to be able to raise the money to build that project. So it's just going to be an orphan project eventually. Like, nothing's going to happen with it. And so those are the developers you really want to avoid owning. And, and I would say, unless it's just something that's like it's trading for pennies on the dollar, like unless it's super way undervalued. And so this comes into optionality. And again, I prefer silver more than gold optionality, because silver will rise more than gold. So these types of plays, they have more upside with silver. So that's how I'm looking at a lot of developers. And then the other thing I'd add on to that is, when you are looking at exploration companies and, the smaller, maybe they have a small resource or they don't have a resource, the market loves size. So when you're looking at these companies, like they got to have something that's 3 million ounces. Otherwise, the market's not going to care about it. So if you have a stock that has 1 million ounces or 1.5 million, and it's just underperforming, it's not really doing much, it's because it's too small for the market to care. Now, yes, that deposit can grow to 3 million, 4 million ounces, and then that stock will obviously make a huge move higher. But we're looking at non-producers. These are, kind of avoid orphans and then avoid small deposits. Like, those would be the two things I would say when we're not looking at junior producers.
Okay, those are good topics. You know what? There are a lot of orphan companies out there, a lot of companies that are still around looking for that takeover. Sometimes, a lot of the time, redoing economics on their asset. And boy, oh boy, we see them getting cycled through. Those stocks can also do well in these bull markets, especially a bull market like you're outlining. But there are other stocks out there, other companies that offer simply more upside. As long as this all just keeps following through and we continue to get the breakouts that you are looking for. Jordan, thank you very much for your time. We'll follow up with you next week, hopefully still talking about breakouts and still talking about this upward momentum. I hope you have a great rest of your week there, Jordan.